All right. Thank you everyone for joining us. Hope everyone's doing well, staying safe. A couple of pointers in case it's your first IntoTheBlock webinar. We will be recording the presentation. So if you're not able to stay for the whole duration, you can watch it in our YouTube channel. You can also share it with your friends if you liked it. As well, if you have questions related to a particular slide, feel free to write questions in the chat and the Q&A. Myself and the team will be keeping a close eye on the questions, as well as we'll have a more elaborate session for questions at the end. Okay, so without further ado, let's get into it. So as you guys know, the topic for today is centered around decentralized exchanges. And I'll be covering it within three main subsections. One is the rise of automated market makers, which are now the dominant model for decentralized exchanges, both on Ethereum and other blockchains. Then I'll get a more analytical approach into the current state of DEXes. So we'll be covering key data points from volume, liquidity, capital efficiency, fees generated, and many more data points across some of the industry-leading DEXes. And finally, we'll cover some of the potential opportunities that lie ahead for the decentralized exchange space in general. Before that, as we typically do, quick update about IntoTheBlock. As you guys may know, we have several ongoing partnerships with industry-leading partners. So in the past 3 weeks since last webinar, we've launched these three main partners: Alpha Cash, CoinFlex, and Bybit, which, as you guys may know, is one of the largest derivatives exchanges, centralized, that is. And in terms of releases, this is of course quite related to the topic that we'll be discussing today. We release metrics for Curve, as well as fees. So you can now see the fees being generated by Ethereum, Bitcoin, and other layer 1 blockchains. And in the DEXes sections and the protocol insights, we also added insights on the fees being generated by these exchanges. And this is a bit of a teaser. We've been working on it for the past few months or so, and we'll be launching in a lot more decentralized exchanges their data. As well as we'll be integrating with some of these in their platforms, similar to how we already do with SushiSwap analytics. We will be hopefully integrating with some of these partners, and I'll be covering some of their data today, and you guys will be able to get the full view of it soon enough within our platform. All right, so let's get into it. Many of you guys might not remember, or might have not even been into crypto back then, but decentralized exchanges have been a concept thrown around constantly since the early days of crypto, really. However, they were very clunky at first. They tried to imitate a skeuomorphic design based on existing traditional exchanges. So this is Ether Delta, which at the time used to be one of the highest in terms of volume, of course, negligible compared to the amount of volume managed by decentralized exchanges right now. But the idea was to have it completely peer-to-peer, so that each buy order would have a sell order on the other side of the book, whereas right now it's more peer-to-contract. So you interact with a smart contract that holds the liquidity from other users depositing liquidity, whereas before it was more you submit a buy order and then you have to wait for a sell order on the other side of the equation to align. So that was, of course, quite slow, often taking even days, and it was costly to get these orders matched. It still is to a certain extent, and some took this a step further in order to make it a bit more efficient, taking the order books off chain, but it didn't really get product market fit as much as DEXes do right now. And the main innovation behind the recent rise of decentralized exchanges is this model called automated market makers. So this concept has been essentially researched mostly within the Ethereum community back in, I believe it's as early as 2016 or early 2017, with Vitalik even proposing research to be done there. Banker was the first to actually implement it and launch it. But based on the research from Vitalik, Hayden Adams from Uniswap also got this model started and launched V1 of Uniswap, and then the following versions, which of course turned Uniswap into the leading DEX. And what is different about this model compared to previous decentralized exchanges and centralized exchanges right now is that they democratize the liquidity provision into protocols. So while in centralized exchanges, you have a handful of entities providing liquidity, selling at the bid and buying at the ask. Sorry, the other way around, selling at the ask, buying at the bid, providing that liquidity in the limit order books. Right now, the liquidity with AMMs is provided to a smart contract, which constantly is rebalancing and providing orders between two pairs of two assets. So this is the formula that they use, which provides the liquidity for asset X times the liquidity of asset Y equals the K constant for liquidity. And that liquidity is being rebalanced 50-50 between the two assets, such that there is liquidity available for both assets at market prices. And this is done also by incentivizing liquidity providers, which is being achieved by giving volume fees from the volume generated, typically around 0.3%. But with novel solutions also came new problems, which many of you might be familiar with, which is the impermanent loss. So in the process of being rebalanced, your positions as a liquidity provider, if the prices of these two assets diverge, you would end up with significantly more of the underperforming asset, and the net value of both of your positions can often be less than if you had held those two positions separately. That is because you're, as I mentioned, getting more and more of the depreciating asset in order to rebalance your liquidity. And this term is called impermanent loss, but as some of you might have learned the hard way, it can be quite permanent if prices don't go back to parity. Okay, so there's many reasons that I'd like to explore behind the success of AMMs. One is the reality that crypto, since its beginning days, it's been surrounded by speculation, even though the industry's grown and provided a lot more diverse use cases. I would still say speculation is crypto's killer app. And with that brings the opportunity and is the high demand for a trading platform that not only people can access permissionless without any KYC or regulations imposed, but you can also do so anywhere where you have internet access. So it's very accessible. Well, I guess this is the case for DEXes in general, but there's high demand for trading in a decentralized venue. Another reason for the success is that it provides the incentives for liquidity and wealth generation. So as I mentioned, it does so by providing fees generated to LPs And it's also progressed into giving tokens and revenues to token holders, which I'll talk on a bit further down the presentation. And it's also another key reason for the success is that it's able to kickstart liquidity for long-tailed assets. So tokens that are, I don't know, not in the top 100 in coin market cap and based on their market cap, you usually have to go through a whole process of due diligence with centralized exchanges. There's often a fee involved in order to get them listed. And it's, as you guys can know, it takes quite a bit of time. Whereas decentralized exchanges can list tokens in a permissionless manner and create liquidity pools organically without having to rely on any central third party to approve it. So this reduces friction and enables the creation of liquidity quite quickly, probably as quickly as possible as you can for long tail assets. So this has been one of the reasons behind the success in a space that moves very quickly like crypto, where you have suddenly tokens that have launched, I don't know, within a month and are doing quite well. These might take a certain amount of time to be listed in centralized exchanges, but they're already listed in decentralized exchanges, always putting them one step ahead in terms of speed in that sense, at least within that blockchain. Another underrated benefit that I would say has led to AMM success is the ability to go from what I'm calling from A to C. So you can trade, for instance, Chainlink for Uniswap token without going to USDT or ETH in between. Of course, it does so behind the scenes, but for the end user, you don't really need to know what's going on. You just literally say, I want to drop this asset and get this other asset without having to go on an in-between step, making things a bit more seamless there. There are trade-offs, however, with AMMs. The first are pertaining to the blockchain's smart contract platforms in which they're built on top of. So traditionally, in blockchain research, there is this concept of the blockchain trilemma, which is having to choose between two of these three core pillars of blockchains, which are the factors of scalability, typically measured in transactions per second, decentralization, measured usually in number of nodes and validators, and security, which is a bit harder to measure. And there's often, I'm seeing from my experience, that security and decentralization to align more, but there's a bit more of a trade-off, a greater trade-off between scalability and decentralization. And with scalability, you can essentially handle more and quicker, cheaper transactions. There's the other trade-off between decentralization and security. So for instance, a system that has a small number of validators might be less secure than one that has a high number of validators and is highly decentralized, like is in the case of Ethereum. Within the AMMs themselves, I would argue there are other trade-offs that these protocols assess. So one is the ease of providing liquidity versus capital efficiency. So this trade-off is not as apparent at first, but after analyzing Uniswap v3 more in depth, it seems that the design is created in a way such that the liquidity is concentrated essentially near the trading value at the time. And what that does is that it creates incentives for liquidity providers to make more active positions, essentially in a narrow band in order to generate higher percentage of the fees. But it involves a lot more complexity, as of course you have to go into strategies and on how to manage that risk and the position as you move it. And this is the main trade-off that went into the design of Uniswap v3 versus v2, where you cover the whole spectrum of price, and it's quite an easy experience for an LP, but it's not as capital efficient, as I'll dive into. All right, so now into my probably favorite part, which is the data. So I did an analysis of some of the top 5 DEXes. Every now and then, a newer DEX gains a bit more market share in terms of these metrics. But all in all, these are 3 of the largest players: Uniswap, SushiSwap, and Curve, in their different versions. In terms of liquidity, so it's often referred to as total value locked, the amount of liquidity supplied into smart contracts, in case you're not familiar with the term. In this case, it's the same for DEXes. So liquidity provided, as you can see, has surpassed, for Curve, they've already surpassed over $10 billion. Uniswap v2 reached there for a little while, and this was even after their liquidity mining had expired, campaign had expired. But all in all, we've seen massive growth in liquidity throughout DEXes. One of the things that kickstarted this flow of liquidity into AMMs is this, in case you guys are not familiar, is the concept of liquidity mining, also known as yield farming, which is done by incentivizing people to provide liquidity and receive native tokens from these platforms in reward. So the first DEX was actually, to try this out, was actually Balancer, which is unfortunately not here, but due to their lower liquidity at the moment. But Curve has managed to increase their liquidity with a very high rate of issuance of their token, and it's led them to become right now the #1 DEX in terms of liquidity. And SushiSwap, which did their famous vampire attack, where they sucked liquidity out of Uniswap, for a little while they launched with higher liquidity than Uniswap, since they incentivized existing Uniswap v2 LPs to migrate to SushiSwap and earn the Sushi token in rewards. And that managed to be it managed to prove how liquidity is a bit more fungible and can move from one place to another easier than was once thought of. And overall, it's led, well, I won't say liquidity mining alone, but it has helped DEXes grow 50x year over year, and 4x year to date. I have anonymous attendee getting a question from my data source for feeding the data. This is actually gathered up by us from IntoTheBlock. So all the images that have the IntoTheBlock logo in the background we gathered the data ourselves, extracting data from the smart contracts and the blockchain itself. For charts that I do get external data, I'll provide the sources. In terms of volume, so volume, of course, is another key metric. I would argue is even a more relevant metric than liquidity, especially considering how liquidity can quickly move from one place to another. Volume speaks more to the demand for a particular venue for exchange, for trading. And in this sense, Uniswap remains the leader. Especially right now, Uniswap v3, which is doing so with a lot less liquidity, which is impressive. And the growth overall has been in an upward trend. I took a bit of a smaller time frame just because it's a bar chart, but year over year, it's managed to grow by 14x, 2.5x year to date. This, of course, is not a full sample of all DEXes, but it's big enough of a sample to get a good representation of the growth in the industry. I also want to mention that there is some experimentation being done in terms of incentivizing volume. In the past, centralized exchanges tried this mechanism called transaction fee mining, even before liquidity mining, in which they gave tokens to people for transacting on their centralized exchanges. This led to a lot of fake volume. But DYDX, derivatives DEX, is iterating on that system and providing essentially tokens, their new DYDX token, to traders based on a model of the fees and open interest that they're providing to the DEX. I'm just listing this here as it could be a potential catalyst, and it would be helpful to see how this changes the industry in general. Of course, as you guys may know, from the volume, liquidity providers and in some cases token holders earn fees. In this case, Uniswap recently became the first protocol to surpass 1 billion in lifetime revenue being generated by its supply siders, so the liquidity providers. And of course, this is a big accomplishment, taking into consideration that Uniswap v2 launched just in May of last year. So it reached 1 billion between v2 and v3, including v1, which of course wasn't as successful in terms of volume. And it's recently launched Uniswap Alpha on layer 2 on Optimism. They've accumulated around 1.02 billion in liquidity, in fees generated, which I think is quite impressive and in a large milestone for crypto in general. And in aggregate, between these 5 DEXes that we've been covering, annualized fees have managed to I'm taking for context, I'm taking the 7-day average fee generated between all of these 5 DEXes. Of course, if I just took 1 day, it might not be a great sample. So I'm taking the 7-day average. And at a point in May, as prices started crashing, there was, of course, a lot of volume activity, which led to multiple billion in revenues being projected. But of course, there's the difference in that some of these revenues go directly to token holders, like is the case with SushiSwap and XSushi, whereas in Uniswap, all of the revenues go to the liquidity providers. And there's quite a controversial issue there, which is not, I don't have enough time to go into all the full detail, but it's essentially a trade-off between the risk of being a security, because if you're providing revenues to token holders, like shareholders, proxy, there's a higher risk of being considered a security, but at the same time, it's easier to prove the value in a way of something if it's creating dividends, like Sushi is. I'm getting a question from Akash. Can you explain how to analyze Uniswap v3 LP provisioning? How to see how people are depositing liquidity and changing it as price changes? Okay, Akash, I'm running a bit low on time now, so I'll get back to your question later at the end of the presentation. In terms of capital efficiency, which touches on your question, Akash, I measure this by calculating the average daily volume in August, in this case, over the average liquidity throughout that time. And as I mentioned, since Uniswap is concentrating liquidity very close to the market price, that leads to them being able to handle a significant amount of volume in the volume to liquidity ratio, outperforming in this metric significantly all of these top DEXes. and creating an environment where traders can get slow slippage despite its relatively low total value locked. There's also non-quantitative metrics to consider with DEXes, which of course are the decentralization of governance, how many token holders these assets have and how distributed they are, the involvement of the community, which potentially ties into the gray area of what is decentralized enough to not be considered security, as was the case with Ethereum in a CFTC case back in 2018, I believe. So essentially, these protocols are trying to decentralize themselves, both in order to provide the positive outcomes to in a decentralized manner, like LPs, and also to mitigate the risk of being a security. In terms of censorship resistance, we recently saw the first intervention with Uniswap Labs removing tokens from their front end, not from their smart contracts. Smart contracts remain decentralized, but they did remove tokens that appear to be securities. It's unclear if they got notice from a regulatory body, but it's very likely that's what happened. So this brings attention to the censorship resistance of these protocols, and also ties into the definition of what is a broker, which is a highly debated topic with the legislation behind the infrastructure bill, and makes you reassess the benefits of having an anonymous team, which can be seen as risky because it's potentially less trustful. That's easy to trust someone that's anonymous, but also makes it more resilient in cases like this, since it's harder to essentially apply pressure on them. I have a few minutes, but I'll go ahead with the path for DEXes. I'm a bit optimistic and just put this for a joke. Anyways, everything, most decentralized applications are going multi-chain, from BSC to Polygon to Polkadot. More blockchains are getting integrated one with the other, and they're also going multi-layer, so from layer 1 Ethereum to Optimism, Arbitrum, and so on. And I think the key here is to make it in a way that the end user really doesn't even realize that they're going across chains, do it as seamless as possible. Of course, it sounds easy, a lot easier said than done. And I would put an emphasis on security, especially after what happened with the Poly network bridge that lost 600 million in an exploit just yesterday. And a thing to consider here is how incentives play out with liquidity mining. So right now, we're starting to see liquidity mining campaigns in layer 2. And I played out a very simplistic scenario of what could happen. And it is in terms of measuring the change in liquidity. If neither do liquidity mining, then there's essentially little incentive to migrate. Maybe some will want to use L2 to save the cost, but it also involves the cross the bridge. However, if only one of them does liquidity mining, then there would be a decrease potentially from the other layer, and a double increase in the layer that's actually doing the liquidity mining. And my hypothesis is that it will bring a net amount of new capital inflows if both layers make liquidity mining. And I base this on the case study, I guess, of Aave, which became one of the first protocols to do liquidity mining across layer 1 and layer 2. They managed to get 20x liquidity in layer 2 within just a week. I think it's something like 300x or something crazy like that from here when it launched to the top. However, during this time, layer 1, even though they continued their liquidity mining at the time, they dropped 10%. So they both had liquidity mining, and it caused a short-term drop in layer one's total value locked. This year is just for layer two, well, sidechain Polygon. And overall, however, over 1 month, both layers continue to grow, with both liquidity mining campaigns being live. In terms of addressable market, which is one of the last points I want to get across, we're still quite early. Decentralized exchanges are managing around 10% of the total trading volume, comparing decentralized exchanges versus decentralized exchanges. It's increased around 25%. So not 25% in absolute terms, but in relative terms, and 27x since 2019, since 2 years ago. So this really shows the impressive growth that AMMs are going through at the moment. And there's also, that's just within centralized exchanges, and that's just within crypto. There's also opportunity, even though it's further down the road, to start competing with traditional exchanges. As I think one of the key factors that take a role here is how they're able to incentivize essentially involvement from the community and investors in a way that wasn't possible before, through what is the term that Jesse Walden coined from Variant Fund, the ownership economy, in a way that token holders have incentives to, in a decentralized manner, help protocols in a way that before it was restricted to a centralized number of relatively small employees. And this has led to a small amount of people. So in this case, Uniswap has about 37 employees, but they're able to generate supply side revenues of around $32 million per employee. Of course, I emphasize supply side because they're not being generated by the protocol itself, but it's impressive nonetheless. Finally, something that's a bit further down the road that would be interesting to look at is if they end up converging with NFTs, which of course are having massive growth over the past few months. They're also a different type of exchange. OpenSea, if you think about it, it's not that different, other than they support a different token standard. There's already fractionalized NFTs from NFTX and a few more, which might be the first step in getting these two worlds to intersect. But I certainly would expect a bigger intersection between the two largest sectors within decentralized applications. And even further down the road is the idea of having securities on the blockchain. So I had a comment before about issues with KYC and AMMs. Of course, if you do decide, if the DEXes do decide to launch securities and security tokens, which of course are a very nascent industry, it would involve having to restructure how it works, and it would more likely be a more permissioned approach, but also a bigger potential addressable market. So I'm excited to see how that plays out, at least myself. Of course, I don't have all the answers, but it's potentially a market where these decentralized exchanges can move into down the road. So to conclude, decentralized exchanges have grown into multi-billion-dollar organizations within just a couple of years. It's crazy how fast they have grown. They're generating massive volumes and revenues for both liquidity providers and token holders. How you value those is still very much in the early days, but it's worth noting the difference. I would like to highlight that these remain in a highly experimental phase. So things like token incentives, for instance, I remember when Curve just announced their issuance, it was highly criticized having such a high amount of inflation going to liquidity providers, and results ends up happening that they create incentives for not a continuous selling of these tokens. And even though it hasn't been a top performer, the CRV token, the protocol itself continues to grow and transact more volume. So I would argue that this is still very much in the experimental phase, and we're just getting started when it comes to layer 2 incentives and cross-chain incentives. So I would think these have the potential to further propel the growth of DEXes in the next couple of years. So all in all, I would argue there's still DEXes are still in the early days and have a very high addressable market to go. All right. Next webinar will be centered around NFTs. Of course, they've experienced a massive resurgence over the past few months and weeks in particular. And now I will dive into some of the key metrics and insights behind this growth. So make sure to sign up. Our team will be sharing the link right now there in the chat. Make sure to sign up. Thanks everyone for listening. I already have a couple of questions. So I'll start getting into questions right now. Okay, Akash, thank you for your patience. Regarding your questions, can you explain how to analyze Uniswap v3 LP provisioning, how to see how people are depositing liquidity and changing it as price changes? So I'll start with the first part of the question, of course. Okay, I guess it's probably the best slide for that. So what Uniswap v3 does differently is that instead of allowing you to provide liquidity in the potentially infinite price range, so from 0 to infinity for price of an asset, you can concentrate the liquidity into a smaller price range within that asset. And what within that pair, and what that does is that you earn a higher percentage of the fees as long as the price is within that range. Whereas before, you would get the same amount of fees since everyone is providing liquidity across the whole range of the price. So having the liquidity being more concentrated near the price allows you to have less slippage, since there's essentially you don't care that much about liquidity that is 80% away from current price. It doesn't add that much value for active traders. So what this by concentrating it, you create a low slippage environment, and it also provides the opportunity for advanced liquidity providing strategies to move their positions as prices change. You can see this in the Uniswap info. They have a chart on that. We're working on some metrics with Uniswap v3 as well and strategies there. So hopefully in the not so distant future, we can also provide those. Another question. Also wanted to know your thoughts on Curve and SushiSwap introducing concentrated liquidity in their next updates. Yeah, so Curve right now, these are the numbers for Curve v1. They did in their v2 introduce a similar structure than Uniswap, but they're doing it not across pools rather than pairs. So they launched a tri-crypto pool, which is across 3 assets, and they still have the risk of impermanent loss, which is new to Curve. But they managed to concentrate the liquidity in a similar way and have a low slippage environment despite low volume. So they're slightly similar. Haven't seen exactly how SushiSwap will do so, but I'm pretty sure they're moving in the same direction with the Trident AMM whenever that launches. All right. I'll give a couple more minutes for additional questions. 1 second. Okay. I think that's it for questions. Thanks everyone for joining us. Hope you guys all have a great day wherever you are, and make sure to sign up for the next webinar. Bye now.